Good morning to all our participants this morning. I do see quite a number of people are still joining. So we will give it a minute or two to allow a bit more people to join. And we should be started in the next 2 or so minutes. Okay, good. So I think we are good to go. I would like to really welcome all of you participants, our clients, and across East Africa that are joining us from the various banking institutions. This is the fourth series of webinars that we are doing and covering various topics across the banking space. Today, we shall be tackling a topic around transforming the lending operations, in this digital era. And I'm joined by a number of experts from KPMG. For those of you who have been able to join the previous webinars, you will have interacted with our partner from KPMG in India, who supports us here in Africa, Amitava, who is on the call and will be speaking to you in a couple of minutes. And also Daniel Thogo, who is our manager in our financial risk management with a wealth of experience in the banking sector, having worked with our regulator here in Kenya for probably a decade, and also having worked in the banking sector space. My name is Daniel Karuga. I'm partner and head of enterprise risk services within East Africa. And I will be your MC for this morning. So without further ado, let me invite the first speaker to speak to us about the landscape that we are seeing on the when it comes to the digitization of the lending processes. So Daniel, and then after that we'll have Amitava to speak to us about the solutions that would help and support you as our clients, as participants, in terms of digitizing that process. Daniel Thogo, over to you. And perhaps as Daniel takes it up, please feel free. There is a Q&A section with the, within this Zoom. Feel free to type in any questions or any comments, and our teams are available to respond to you. Daniel, over to you.
Thank you, Daniel, for that kind introduction. And good morning once again for the people who have been able to join us this morning. It has been a very learning. It's been a full week of learning from Monday when we did IFRS 9. And then on Tuesday, we did ICAP and ILAP. Even yesterday, we looked at the risk-adjusted return on capital, that is on RAROC. And today here, we're discussing on lending and how do we modernize lending in this particular space. And I know most of us here, we know that one of the key area, or one of the responsibility of financial institution is financial intermediation. And banks or financial institutions will not exist without lending. So as we look at lending modernization today, what does it mean in essence? And here we are talking about is that for years, credit underwriting in our markets, and of course in the Asian, in the African markets, it has been judgment based. And what do I mean by judgment? It has been, you go to the branches, to the head offices, heavy files, it's reactive. And of course, the decisions are driven primarily by experience more than by data. And at the age that we are living in, everywhere you're going, in terms of even the changes in the policy frameworks, we're talking about data. So as we are going to be talking about modernization today, where then does that data come in, and what role does it play in terms of also the systems that you're having in place? And of course, you find that institutions invest heavily in systems. So we are saying that if you look traditionally where lending business has come, is that model worked when markets were slower and customers' expectations were also lower. But today, we operate in a very different environment. And it is defined by instant expectations. There's data abundance, like I have mentioned. And of course, the regulatory demand for transparency. And you're going to be finding where this particular conversation and how it features within the current regulatory framework within Kenya and even the larger East African region, Uganda, Tanzania, and even Rwanda. And even right now, as Ethiopia moves from Basel 1 to Basel 2 and 3, that you will find that the regulators right now have a key say in terms of how then banks conduct their lending. So as you're talking about lending modernization, then how do these particular concepts come into play? We're saying that when we're talking about modernization, we are not talking about replacing systems. We are saying that it's about shifting from paper and judgment to real-time, data-driven, explainable lending. And we are saying that the regulatory expectation, and as you're going to be noting here, is that loans are expected now to be priced fairly at customer level. And you're going to be finding that loans, they are being monitored continuously across the loan life cycle. And so you're saying that this particular aspect of modernization of lending, how then is it governed under strong prudential expectation? So precisely we are saying that modernization rests on a number of pillars, 5 pillars to be specific. And one, we are saying is data plumbing. And what do you mean by this? We're saying that we are connecting what we already have. We are not starting from scratch. We have systems, we have invested heavily in terms of credit. But then we are saying that if you look at the core banking system, the CRM, the data you're getting from the CRBs, and even alternative data. And the alternative data is one of the things that we'll be able to speak in this particular discussion for the next 15 or so minutes. And they're talking about decisioning stacks. And here we are saying that combining, the policy rules, the credit policies, the procedures. And you're saying that right now, with the artificial intelligence that has come in and the machine learning, how then do they integrate for faster and even for, fairer approvals? You're talking about granular pricing. You're saying that using, like, for example, what we were discussing yesterday on RAROC and the cost of funds, how do we integrate all these particular aspects with the data that you are having to ensure that the pricing that you are having is able to guarantee us that when I lend to this particular customer, this is the kind of return that I'm getting. And when I lend to this particular customer, the loan I have priced is accurate and I'm getting the required return. Then you're talking about the life cycle control. This particular data that you're getting, how then do you integrate them to be able to ensure that we have even the early warning and behavior monitoring within our system? But let's pause a bit and look at, for example, what is the regulatory posture with regards to lending. Once the regulator licenses financial institutions, what does it do? Does it stop there? Kenya has been very vocal. And if you look at CBK, actually from 2019, and after it issued the banking sector charter, it issued also the risk-based pricing model. And even before that, you remember the Banking Act had put the interest rating cap, the capping of the interest rates. So you find that there is a particular continued push where the regulators and even governments, they want to find out why banks are pricing loans in a particular manner. And that particular question this year in Kenya, there's a Kesonja framework that has come in, and it requires institutions to justify and demonstrate how they are charging loans for customers. If you look at Rwanda, they have a particular platform. They call it Gereranya. And this is in the Rwandese Swahili, or even the Congolese. It means linganisha. It's meant to compare. And it says that institutions have to disclose what is their cost structure. And then you're talking about Uganda in terms of how they are redefining in terms of their data infrastructure to ensure that data is more cleaner. Tanzania and Ethiopia, even as they move from Basel 2 and 3. These are the kind of the conversations that they'll be having. So essentially, we are saying here today that lending, it isn't just an issue of you going and marketing, your products and getting the customers. Is that by the time that you are pricing, you will be required to justify and demonstrate how you have been able to anchor your principles to that particular pricing. And how then can you be able to do that if you're not having a modernized aspect shifting from the traditional to the modern one? But then with this modernization, then the key question then we want to pose and ask, then what is the trajectory? Where are we heading and where are we going with this one? And we are saying that it starts with improving the decision quality. And then you're saying then it evolves towards data-driven risk pricing. Then we're saying that it culminates in a unified ecosystem where I'm saying that the credit now connects with liquidity, with capital. And one of the things that many people possibly do not appreciate is that when you find credit risk being mismanaged, or maybe there are some pitfalls, or there are some things that have not been captured well, you find that credit risk has a very good correlation with the liquidity position of an institution. Because if you're lending and you're not getting the money back, it has an impact on your liquidity. It also have a very big impact on capital, because if you look in terms of how the risk-weighted assets are computed, is that it becomes part and parcel, is that it can't be treated in isolation. It can't be treated as a standalone risk. So you're saying that with lending modernization, you're incorporating and integrating all these things to find out at any one point in time, how do they affect each other. But then for us to be able to achieve there, we are saying that it has to shift from being judgment-based. And then you're saying that it has to incorporate the machine learning, the artificial intelligence, and to say that the decision that we have arrived at, is it explainable? And it will be a very interesting conversation. And I know among us of in this particular platform, like in Kenya, the central bank gave the guideline and cautioned financial institutions that how they are using the AI, they should be able to ensure that the customer data, the privacy is guaranteed. So is it a situation where the institution would shy away from using the AI? Do they risk being left behind? You're having the other competitors like fintechs, they're using AI. How then do they draw the line between leveraging on its capabilities, those particular machine learning models, to ensure that they can be able to come in and get the data that we are calling alternative data, as we'll be speaking here. So if you go to the next step, we are saying, what then is a business case for us? Why does it, what are the opportunities in this particular aspect? We are saying that modernization, I have just mentioned, of the regulatory posture, it isn't just about compliance exercise. We are saying it is a commercial enabler. And how does it do this? Let us look at 5 key areas here. And one, we are saying, first is win. We win on speed. Because we are saying that digital first, data-driven processes, they allow and they make lending decisions in minutes. So you're finding that there are some customers, and you're talking about in the era of Gen Zs now, they are going to be, the people are being employed now, they're earning salaries, they're going to demand even these particular credit facilities. You look at the demographics is changing. So these are people that do not come and wait for you to give them a loan. And you're telling them that your loan is still under the appraisal processes. It's going to take a whole week, and they need to make, purchases. They need to make, buy things online. So you're saying that at the end of the day, as the data availability changes, as intelligent systems come in, there has to be that particular value that institutions can be able to deliver from there. And you're saying that everybody who is in an institution right now, be it the head of credit, be it the CEO, be it the CRO, these are conversations that for them, they have to understand how then do we able to use this particular information, the system that we are having, to be able to ensure that we're able to score our customers better from the SMEs in our retail customers. How then can we be able to drive even the market share in this particular digital era? Then the second one you're saying that is that we price with precision. If you look at what we discussed yesterday and about the need for us, the capital that we are deploying out there, and to ensure that in terms of even the shareholders' return, and even in terms of the cost of funds, we are saying that we are aligning every shilling we lend to the true risk and the capital it consumes. So for every shilling we put out there, what is the risk that is going with that particular shilling in terms of the capital as well that it consumes? And what this does is that it protects the net interest margin for institutions. It expands that particular safe lending even to new segments. So you find that it has a very key impact even on the strategy and even the growth of an institution. And we're saying that it ensures that it meets the risk-based pricing models that we are finding. Like right now, institutions are going to be submitting their loans, their pricing models for approval at the regulator. The CBK, and I've had this experience when we were implementing the RBCP model in 2019, is that the CBK and even the regional regulators, they always say that the business is yours, but how you come to price this one, you have to convince me that this is how you are raising at this particular pricing. But then you say that data does not lie. Numbers do not lie. If you're able to price with precision, use the data that you're having, it becomes easy. And then that we are saying that we lower loss volatility. And what do I mean this? Is that the system that comes up with modern lending modernization is that they have early warning triggers. We're talking about how then can you be able to incorporate in terms of your scenario designs, how you're going to ensure that you're having behavioral monitoring. And one of the examples that I love using is that if you look at the insurance industry, if amongst of you, there's somebody who is possibly 24 years old or even below 25, and you are a young man and you buy a Subaru, the insurance industry will be very reluctant to give you an insurance cover because of the kind of the behaviors that has led to so much losses because the behavior now it becomes important. But then if you look at the kind of the data that we have, does it give us alternative data to ensure that we also be able to incorporate behavioral monitoring into the portfolios that you're having? And then fourth, we are saying, the regulatory goodwill. How then do you convince the regulators that the pricing that I'm also disclosing is able to ensure that for me, I am able to be fair, I am transparent. And funny enough is that as we are speaking right now, I think in the last quarter, CBK was able to audit financial institutions and was able to penalize them, even though due to the fact that they were not pricing their loans within the approved risk-based pricing model. And the penalties have actually gone so high because you're talking about one violation in between 5 million to 20 million. So are these things supposed to ensure that they help us, or are we lagging behind? And that is why the discussion on the modern lending modernization becomes critical. And then finally is that we unlock data that drive growth and insight. So if you're coming to borrow from me, I would also want to be interested. What other bills do you pay? Do you have electricity bills? Do you have other things that you're able to ensure that you are financially prudent? Your M-Pesa statement for all those particular MSMEs that don't have even audited financial statements, what data can we be able to leverage? And how then the intelligence system and even the AI platforms can be able to ensure that we do this. And before even we go to find out what then are the solutions or even the opportunities that they can be able actually to derive from the array of data that we are having. We have seen that the opportunities that we are getting, they are simple, is that speed will win customers, precision protects the margins, and you're saying that the visibility that you are having over the entire portfolio reduces the losses. And then you're saying that if you're pricing your loans in a transparent way, then you're able to win even trust from the other stakeholders. And then you're saying that the integration of this particular data, it will drive growth. But then, what are the challenges? And I've mentioned there, and I will not repeat, like, for example, for speed. Speed is a challenge. There are some loans here. There are some institutions I know, customers, they apply and then they even just forget. They just follow up with calls. They are told, before the loan comes from branches, before it goes for all those particular approvals, it becomes, a very big challenge. And then you're saying, and the one thing that I would want to mention here is that there isn't like the lack of alternative data. The data is available, but then how then do we use it? You'll find that like 70% of MSMEs, and I think this is a study that was done by the FSDO, the Financial Sector Department, Kenya. They lack the financial, footprints. Their financial footprint is not in the audited financial statements, and it exists in, documents like mobile money, POS data, or even utility payment histories, like I've mentioned there. Then the limited portfolio monitoring, these are some of the challenges that when you find that we give a loan and you only know that it has non-performed when it is in arrears. And this now beats even the logic of how now institutions have adopted IFRS 9, that it is forward-looking. How then do we be able to use the data and the modern aspect of lending, other than the one that you have been doing in a traditional way? If you look in terms of the subjectivity and the inconsistency, the similar loan being evaluated by one particular analyst in a branch, they'll come out with a totally different metric or even a recommendation. Then you're talking about, of course, inadequate risk assessment and, of course, integration gaps. And here, even talking about the integration gaps, you're saying that the systems, and I like calling them the legacy systems, they don't talk to each other. You'll find that we have, people in credit, they have their data. You're having, of course, people who are doing the database administration, they have those particular data. You're talking about, people in risk, people who are doing the financial modeling, people who are doing ICAP, people who are doing the strategy. They have their data, but all this particular data is in silos. The lending modernization here is saying that the data that we give out even for analysis, it should provide a feedback loop for us to be able to say that we can be able to have and even draw learning lessons. How then do we connect all these particular data streams to be able to give us a single customer view and cutting processing time dramatically as well? And the culprits, of course, the inconsistent models. You are having, the people in credit. You move from, the head of credit comes with a new particular model, how you should be able to, to evaluate credit risk. They come up with a different strategy. We don't have insights. When you don't have insight, you're saying that data has not been analyzed for trends and even segment behavior. And you're talking about manual appraisal processes, of course, reliant on human judgment. And lending modernization, we are not saying that we are replacing human judgment. You're talking about non-standardized documentation, and these are areas. And if you have internal auditors in the call, these are the things that you'll go into a file, the credit admit processes. There is no even the valuation of security. You find that even in terms of even the value is there is outdated. Some of the offer letters are not even signed, and all these things. And of course, those traditional approvals can it be embedded in the system that if it meets all these particular criteria, it can be able to be approved. So what is the conclusion? Is that the lending modernization isn't just about credit risk. It's credit process risk. And you're saying that you're not replacing the human judgment. It's about augmenting it with data, automation, and integration. So I would like to take this opportunity to take it back to Daniel so that if he has any comment, he can be able to put it across and invite Mitava so that then he can be able to tell us what then are the ways that we can be able to navigate around some of these particular challenges in lending modernization, or even how then can we be able to do that, and are there solutions that we can be able to do and even apply to support our market and the clients. Daniel, if you're there.
Thank you. Thank you very much, Daniel, for those insights. And participants, please feel free if you have any comments, if you have any questions, put it on the Q&A, and Daniel and the team will be happy to respond to your questions. With that, allow us to transition to another presentation from Amitava. To go through the solutions that we have that enable the lending process. Over to you, Amitava.
Thank you, Daniel. Good morning to all of you. Thank you for giving us your audience. So I'll take you through the second part of the discussion where Daniel Thogo has left in terms of what are the requirements of modernization, what are the benefits of modernization, how modernization can be customized to each and every part of your banking portfolio. So maybe we'll go to the next slide. So what we are trying to do is, as Daniel mentioned, that how we can support you, help you in this entire customer engagement journey. Now, different institutions are at different stages of this journey. Somebody is in a very advanced stage where there is already data collected in terms of their customer data for processing. Vis-a-vis, there are certain customers who have just initiated this entire journey. So they are still in the process of collating all the data, doing an analytics around the data, having a model in place so that there is more scientific evaluation of customers rather than it is left to the individual judgment of different people. So what the solution is trying to do is it is trying to take you into that particular journey and support you in this entire journey. And the version which we are going to show it to you is just not that it's a version which you have developed for a bank. Not necessarily, you will require the exact version. We can simplify it, we can make it shorter, we can make it more objective so that it meets up to your requirements. So that we can get into an individual discussion after the webinar to understand what type of requirements you may have and then customize the version for you. So essentially what the solution is doing is that first and foremost, it is a workflow based solution. So it will take you through right from a relationship manager, sourcing a lead, to a credit appraiser, to a risk evaluation, then it going through the models where it's a certain, and when I say models, it's basically certain criteria which has been predefined, and it will give you some sort of output in terms of rating or a score, which will essentially help you to identify whether this loan can be given a sanctioning or it is rejected by the bank. So essentially, this system, first of all, it holds all the models which are in place. You put the data, it will run through the model and it will give you an output, which will be in the form of a score or it can be form of an internal rating. Second, which is also important for institutions who are in the initial part of the journey, is how you can maintain a very strong, good quality data. Data may be very few as of now, but there has to be a starting point. If you start today with the solution, then over a 5 years timeline or 7 years timeline, you will be in a better position to say that, look, I have the data on which I can do a lot of analytics. So what it helps is basically it will help you to ensure that good quality of application data is maintained at the back end of the system. The third is model inventory. Essentially, what it's doing is a lot of models, and we can always provide these models are built into the system. We can provide these models quickly to you so that you can start, you don't start from zero, but you start from certain levels. So these models have been tried and tested with multiple institutions in different markets within Africa and outside. So these models are ready-made available to you, or we can customize it based on the models which you're currently using. So both of these options are available to you. And when I say models, it is just not a credit rating model, which will evaluate the goodness and the badness of a customer. Even also, it will help you in calculating your probability of default or a loss given default, which is important for your Basel regulation as well as for your IFRS 9 regulation. Of course, the system comes with a very detailed documentation so that you have a complete understanding as to what is running behind the engine. All the formulas, all the algorithms, everything is documented and given it to you. Any sort of changes which is required in the workflow, in the approving workflow or in the models, we are always there to help you, support you in making those changes. And lastly, whatever data which you are using, it can provide you a lot of insights in terms of various types of visualizations and trend analysis. For example, we would like to understand, whenever we're processing a file, a customer's file, which part of the process takes maximum time and why it takes so much of time. Is there any way I can just evade that particular time? How many proposals have been sourced by a relationship manager has actually been approved and how many got rejected. That will tell an efficiency of the relationship manager. What type of customers I'm approving, what industry of customers I'm approving, what is the group borrowers where I have exposures to. So a lot of reporting requirements, data visualizations, trend analysis can be done on the top of this particular solution. Yeah, we'll go to the next one. Now we come to the key features. When I say key features, what are the main features which are there in the system, which I can demonstrate to you in next 7 to 8 minutes. Of course, as I mentioned, it will help you to do a underwriting of the customers, so the credit rating or scorecard scoring of the customers. It will give you a historical trend of the score in terms of like in 2021, what was the score vis-a-vis in 2025, what is the score. That means that whether the health of the customer is improving or it is not, it is deteriorating. A complete list of model inventories which are using. This is another issue which we have been seeing. Whenever we ask a CRO that what are the total models which you have in your bank, he doesn't have an answer. So he knows that all the models are in haywire, are from different systems. So he does not have one consolidated view in terms of the total models available in the bank. Reporting. So in terms of the entire model usage statistics and turnaround time, all those things can be done. And more importantly, integration with your existing system. So be it a core banking solution or a treasury system or a loan origination system, it can be easily integrated with your current system so that data flow automatically, seamlessly from various source systems into this particular solution. Next slide, please. This is a typical workflow for a bank where which most of the banks follow typically. So if you see on the left hand side, there's a relationship manager who is sourcing the deal. So that particular function is supported by the system. Document collection and submission. The relationship manager will pick up a lot of documents. There's half of the documents is in a physical format. It's not even digitized. People don't know where they have saved these documents, whether it's on the shared drive or in different folders of individual people, or it is physically kept in a particular branch. So that is another challenge. So automation is required for that. What type of verifications are done by credit? So like one of the banks where we were working in Africa, it typically takes 8 days to physically carry the files from one branch to the head office for processing. Now, when we had a discussion with the client, we understood that look, they are physically transferring the file, which takes 8 days just to transfer. Processing is additional. So when we spoke with the CEO, we did automate this. We use this particular solution where you put in the information and the information instantaneously flows to the person in the head office for approval. So the person in the head office gets a prompt that this file has been logged in. These are the details. He will either approve or he will either reject. So the entire 8 days were brought down to 8 minutes. So which is what the solution tries to do. Credit worthiness evaluation. This is again, Daniel mentioned that there are a lot of subjectivity, manual evaluation. One important point also I wanted to highlight is in case an evaluation has been done by for a customer manually, subjectively based on my experience, and 6 months down the line it defaults. That learning is not embedded within the institution. So it's basically my learning what went wrong, but the other branch managers or the other evaluators, they don't learn out of this experience. As a result, the bank is suffering because a lot of NPLs are happening. If we have a system where the credit rating systems are actually incorporating the learnings of all the non-performing loans within the bank, then it makes sure that we don't repeat our mistakes. We learn from each other's mistakes and we don't repeat our mistakes. Hence, it's important that we have a sort of a standardized model where there is consistency in terms of evaluating a customer, and everyone within the bank uses the same rating scale or same parameters to evaluate the set of customers. Loan pricing. Again, we have seen that a lot of CBK has come out with a revised methodology for loan pricing. Other jurisdiction will also have similar regulations. So loan pricing can also be systematized using this particular solution. So it will not only tell you whether this particular loan has been approved or rejected, but also in case it is approved, at what price the relationship manager should negotiate with the customer. The next sixth point is around credit appraisal memo. Again, this is a very time-consuming manual job. It typically takes around 8 to 10 days to create a credit appraisal memo. It is a very detailed document, maybe 40, 50 page document with a lot of information, details, and many of times these things are in text. So it becomes difficult for the reader to identify the key risk or key opportunities and take a decision. What this credit appraisal memo in our solution does is it automates this entire process. So the thing which used to take around 8 to 10 days will now happen instantaneously. We have already customized it based on multiple banks where we have worked, that what are the key factors which needs to be looked into before a loan has been sanctioned. So the credit appraisal memo in a PDF format gets generated on its own, and the bank's key decision management can then take a decision. Of course, sanction and approval, like if the loan has been sanctioned or not, it has been now created in the system. Audit trail is available. Who has approved it, why he has approved it, what date he has approved it, what rationale did he give to approve it. And in case any loan is getting approved on an exceptional basis, the accountability will pertain to that particular person. And he will also have to have a document in terms of why he's exercising this exception. So everything is now done transparently, and a very detailed audit trail is available. Then we come to the eighth point, which is also important, and we see missing it in many banks' processes. Is sort of a pre-disbursement check. Before sanctioning, the committee members would provide you some with certain conditions about these are the basic checks you need to do before we give the loan. Sometimes what happens, these checks are not communicated down the order, and these are not conducted. Hence, there is a loss to the bank. Many a times, these pre-disbursement checks also mention that after the disbursement, what should be the monitoring standard. So again, that is lost between the monitoring team versus the loan sanctioning team. Of course, the disbursement happens in the core banking solution. Limit is set up in the CBS, and then that can be created linked to this particular solution, saying that which are the loans which were sanctioned, finally accepted by the borrower, and which were not accepted by the borrower. Then the solution goes into monitoring side, any sort of limit management, exposure management, tenor management, group exposure management, individual exposure, industry exposure, all these management can be done. Another point would be the early warning signal, which Daniel has alluded to, that in case how we can identify certain signals in an account so that we can take corrective action before an account becomes an NPL. So it will help you to do those types of calculations. Collateral management also plays an important role when we are doing lien marking, which collaterals are in our name, which collaterals we have to release because the loans have been paid, so different types of collateral management documentations can be done. Collections and recovery, so these will be like automated alerts and collections which needs to be done because the client did not pay to you on time, and hence there has to be repeated reminders, follow-ups with the customer so that you are able to collect back your money. And then finally, the account closure will happen when everything is settled. We just simply close the account, and then we monitor as to that we don't have any exposure to these particular set of counterparties or customers. Next slide. So these are some of the key module functionalities, as I mentioned in my earlier slide, and it is managed by various teams within the bank. The first is the business team, where they are sourcing the information from the customer for processing their loan. Then it goes to the credit team, which does an independent assessment of all the data and assessment of the customer. Then it goes to the credit and risk management team, which also does a sort of evaluation of various types of risk emanating from this proposal. It goes back to the business team because they have to now negotiate with the customer, the processing fee, the interest charges, the penalty charges. And after all these things, the memo is getting created, and the memo is then approved by the managing director, CEO, or the committee members so that the loan can then be sanctioned and dispersed. Yeah, next slide. So what benefit does the solution bring in? If you see, it is a completely digitized workflow-based engine. So it moves from one team to another team to third team. Every team is completely aware what are their roles and expectations from them for that particular credit appraisal. So everyone is completely clear what information I have to get, what information I have to feed in, what is the current issues which you are facing, and everything will now get into the system. Of course, data accuracy is ensured because there are a lot of data quality checks which have been conducted at the back end of the system. Automation of reporting and trend analysis are covered. A lot of transparency, accountability will happen because whatever a person does logging to the system, that an audit trail is created. So if you have sanctioned a loan, the accountability will increase because there is a system, there's an audit trail which says that you had sanctioned the loan on these terms of conditions. So that type of thing. Checklist, we have provided a lot of checklists in the system so that everyone is completely aware what he or she is supposed to do. Segregation of duties between the risk, credit, and the business team is also ensured so that there is complete transparency and all the three lines of defense are working independently. More importantly, the turnaround time of processing the loans are improved because you just go through the entire process without any subjectivity and you can quickly go back to the customer saying, is it good or not good? Right. Let's go to the next slide. So what are the key benefits? This is the last slide, and then I'll get into the demo. Basically, customer experience improves. Even if you're rejecting a customer, you are quick enough to tell him or her that their loan has been rejected. If it is approved, then your processing time is much faster than your competition. Business value increases significantly because here you are actually giving a lot of value addition in the entire process. Portfolio quality will improve eventually because you are now having a very scientific credit rating model to evaluate customers, which is consistently applied. In case there are any defaults or in case there are any non-performing loans, the learnings from that default is again embedded within the credit rating model. Hence, it becomes important to have the system so that you are able to monitor the portfolio quality. Of course, the system has its own maker checker process controls. So a lot of controls can be ensured so that there is no slippages, there is no fraud within the institution. Customer data is now saved at the back end of the system, which can then be later on retrieved to run various types of analytics on the data. You can run a risk analytics, you can do a business analytics, behavioral analytics, customer analytics on that particular data. Of course, it reduces the turnaround time because you don't have to no longer move physical files, but only digitally the data is moving and the approval can be much, much quicker than the current process. It is also used as a performance appraisal tool because here you can ask the the relationship manager, the credit team, how much time typically they are taking to process a loan. And that can be a part of their efficiency. And then finally, it definitely enhances the revenue because it also gives you a very structured scientific approach for arriving at a risk-based pricing. With this number, the relationship manager can then negotiate with the customer and ensure that this particular account is actually profitable to the bank. Yes, I think I'll just quickly take over the screen and I will go through the solution. Yeah, let me know if you can see the screen. Wait, I'll just reshare it. Yeah, can you see my screen?
Yes, we can see it, Amitabha. Please proceed.
All right. Thank you, Daniel. Thank you. So, as similar to what we have explained in the earlier webinars, the solution is basically a web-based solution. The purpose of web-based solution is that individual users don't have to install any additional application in their particular desktop or laptop. You just need an Internet Explorer to log in into that particular system. Second is it's very light. So you don't have to invest in or buy additional servers, additional database, additional hardwares. Those are not required. The entire system will be installed on your bank's premises. So KPMG or any other third party will not have access to the data. The data remains safe and secured within the bank. And the system talks to that particular database, which is there within the bank so that they are able to retrieve the data. And this entire system will work accordingly as a workflow. So the data is completely confidential within the bank. And the third, and which is also very important, is that it is basically the entire tech stack has been developed using open source libraries. Hence, you don't need to pay any additional money for any additional license rights. There's no additional incremental expenditure. Fourth, which is also a very key strong point of this solution, is that there is no limitations in terms of number of users. It can be 500, it can be 5,000. There is no additional incremental money which you have to pay to us. You can use it unlimited number of license rights. User access management has been provided. Using that particular module, you can provide differential rights to different users based on his or her role within the organization. So as you see, this is just a web-based solution. I put in my username, password, and then I log in into the solution. Daniel, you can see the second version of the solution, right? The orange color
Yes,
ribbon
yes,
on the
yes, yes, you can see the interface. Please proceed.
Okay, okay, cool. So here what I basically have to do is basically I have to include the borrower ID or the name of the customer, and based on which it will search. If it is an existing customer, then it will retrieve all the information of your existing customer. If it is a new customer, then for the first time, you have to include all the relevant details. Now, what are the information which is required? For example, we go into the borrower details. Here you can see the name of the borrower, which country he belongs to, which region he belongs to, whether he belongs to any particular group, what type of legal entity he is of, what is their contact details in terms of their mailing address, which date they have been established, what type of email address which they have, what is a key contact number's name. So what I'm just going to, I'm showing it to you is just a one client version. If you believe that there are some additional fields which we need to capture, we can always capture that because it is developed in-house by KPMG. If you believe that this is too many fields, we need to reduce it. Yes, we can reduce it for you so that it becomes easy for you to capture. But what I'm showing you is a sort of best practice. This is how other banks have been doing it. The only reason of doing this is you capture enough sufficient amount of data so that you are able to use this data for your customer analytics. So then we have the account information related data. For example, for how many years the account has been banking with us, what is the banking relationship, when is the date when the account was opened, what customer ID we have within the bank, what is the business account number. Similarly, what segmentation does he belong to, what industry does he belong to, what type of business does he run. So all different types of segmentation details is also provided. Finally, the business details and executive details, all the informations are included in the system. And plus, in all the fields, you can always put some additional comments if you wish to include in the particular field. Once the borrow details are included, we come to the risk analysis and mitigants. In here, there are a lot of different types of risk which can be provided into the system. Just 1 second. Uh, Okay, so I'll continue. So, and then, basically in the risk analysis, different types of risk can be included. What type of risk which you think as a borrower you want to as a relationship manager you want to highlight. Then you come to the documentation piece where your different types of documents which is related to the customer, you can upload it. For example, the application letter where the customer is asking for a credit facility, the company registration document, board resolution which the client customer has passed for getting the loan, any shareholder resolution, pre-agreement trust authorities, audited financial statement, so blah blah. So there are a lot of documents which you have asked for. The reason of asking these documents are for the credit management team and the risk team to evaluate independently whether all the information provided by the relationship manager is true or not true. So they can independently approve. So the second part is all these informations are again saved in the back end of the system. So at any point of time, if you want to wish to retrieve this information, you can quickly retrieve from the system. So then we go to the facility details in terms of what type of credit facility the customer is asking for, whether it's a term loan or an overdraft, bank guarantee, performance guarantee, what is the amount he has requested, what is the tenor which they are asking for. They are asking for 10 years, so you can mention that. Facility fee, amount sanctioned, interest rates, repayment mode. So different types of information about the facilities have been included out here. There can be many facilities we can ask for. And similarly, like they may have some facilities, credit facilities with other banks. So that information is also captured. And any exposure to related party, that type of information is also captured within the system. Then we come to the most interesting part, which is your profit and loss account. Basically, what happens out here is the system uses AI to do calculation of all your financial ratio analysis. In case of any trends or any exceptions, the AI will actually identify and highlight to you based on the underlying balance sheet and P&L. So you can have a hard copy of a balance sheet P&L, or you can even update that on the face of the system. You can update that so that you are able to take it ahead. So what I'll do is basically I'll update all the information of my balance sheet and P&L into the system. The moment I do, the system starts identifying various trends. For example, revenue has remained stable, but gross profit have actually decreased over a period of time. Say operating lease payments have increased by 4.29%. Net administrative expenses have also increased. So these different types of trends will be provided by the system so that you are able to identify what are the good things and what are the bad things of the customer. Similarly, in this case, this is the balance sheet. You can upload the balance sheet or you can input the data from the front end of the system. Once you do that, all different types of AI messages automatically starts coming so that they are able to show what type of issues are there within the particular borrower. The good part is once you do this, you can also you can download this information, and more importantly, the cash flow statement gets generated automatically. Using the balance sheet and P&L, the cash flow statement generates automatically, which you can see out here, and any downward trend or upward trend, you can also monitor it out here. Then we come to the financial risk. Basically, here we have recommended a lot of financial ratios which are important for our clients to evaluate. However, if you believe that you want to have additional ratios, we can code that. If you want us to reduce the number of ratios, we can reduce that. But the good part is now that we have uploaded the balance sheet and P&L, the ratios are getting calculated automatically. You don't have to manually calculate the ratios. Everything happens automatically. You cannot edit these answers. These are all created automatically from the system. Then we come to industry risk. So here we can evaluate various parameters for the customer who is there in that particular industry. For example, if the customer is an oil and mining industry, you can give the information about that industry into this particular section. We have standardized all these inputs and outputs which are required. Then we go to the business risk. Here you can evaluate the risk related to the business of the customer, and based on that you can also give your comments in terms of where you believe the risk currently lies. Then we come to management risk. So you can evaluate how good the management is, what is the transparency in their governance, do they have a diversity plan, do they have a succession plan? So all different types of questions which we have given based on which the answers can be given. Now, why do these answers have to be accurate? They have to be accurate for two things. One, the information is getting saved for future usage. Second, these informations are also used to create a credit scoring or credit rating of the customer. So based on the goodness of the answer, the credit rating will be better. If the answers are not so good, the credit rating will be worse. Then we have all the financial ratio analysis. So, for example, tax related, profit related, sales related, margin related, all these informations are there. Why? Because you have already uploaded the balance sheet and P&L. Based on that, these calculations will happen automatically. Then we come to the pricing part. So as Daniel mentioned, that there's a regulation in place for CBK to calculate pricing. So we have coded this entire thing into the system. Certain numbers will be coming from the finance team. Certain numbers will be coming from the relationship manager team. And based on that, the entire credit case on our pricing will also happen within the system. Once that is happened, we can help you calculate RAROC for this particular solution in terms of like what is the RAROC for this particular client? Is it good? It is not good? Is it above the hurdle or below the hurdle? We discussed RAROC yesterday in much more detail. Hence, I'm not going so. But this solution also embeds RAROC as a part of its important modules. Then we go to the collateral details. So here different types of collateral information will be asked and you can update that with all different types of collaterals. Finally, a credit decision module will come in, which is more of a summarized version of all the evaluations which you have done within the institution. So all the good things and bad things and all the financial, everything will get created out here so that the approver can take a decision, an informed decision based on the data. Then we come to the covenants and conditions, where you give us a lot of kind of covenants in terms of pre-disbursement checks, what the client customer has to do. They have to maintain a profitability margin of 15% for the next 5 years. All different types of covenants you can mention here. What is the purpose? The purpose is that once the loan has been sanctioned, the system will again pick it up. What are the terms and conditions of sanctioning? And it will monitor. And in case any of these covenants are breached, then escalation will happen. So you can pick up with the customer that, look, I had given you the loan saying that your ESG rating will be 3, but it is downgraded to 4. So now you have to refund back the money. Once you have done all this information, a credit appraisal memo will be get created. So this is a standard template. Again, if you want us to customize based on the template which you are using, we can do so. However, we will be happy to share some of the best practices so that you are able to uplift your risk management practice. So this is the details of the credit appraisal memo, which you can also download in a PDF format. Upload documents by legal team. This is the last stage of checking. So once all the sanctioning and everything has been done, you would want to have a last and final check done by the legal team in terms of the legality of the clauses, of the collaterals, of the loan facilities, and they can attach all the different types of files into here so that it is also safe for eternity. And so once this is done, here, as I mentioned, the credit decision is where you have to agree whether you are agreeing or you are not agreeing, or you are agreeing with the management override, or you are agreeing with certain exceptions. Based on that, everything will be collated within the system that who had agreed, how he had agreed, why he had agreed. So that's how this entire solution currently works. And then there's other fields also in the system. For example, you can host multiple models into the system. You can use corporate rating models. You can use retail lending models. You can use shadow parameters. You can use different types of models where data is not available so that you are able to process it. It can be a short-term models, or it can be cashback programs. It can be a digital banking program model. So we can create those interfaces so that anybody applies for loan from a mobile app, that message will come in and then the entire credit application will get started. So all those things can be easily done, just that it depends upon your business model and how you want us to do. And then there's a user access management module. Of course, you can give different types of user access rates. And there's a task list also, which basically says that what are the different types of tasks which are available at the various stakeholders. This will essentially help you to identify like what are the key products which are there in the system and what are the current status of the various proposals in the system. Right. So we can go back to the slide now. Can we have the deck back? Yeah. Yeah, so I'll just conclude with this particular slide because this plays a very important role. And I know that a lot of our clients have different questions around data. As I mentioned, and Daniel had also been harping on this point that, every bank is in a very different state of journey. But there has to be one starting point. What basically we are trying to do is those banks who are still in a very initial phases, we want to give a kickstart to that particular bank. Those banks which are in a much matured stages, we are trying to automate or digitize and make those systems more efficient so that they are able to run it on a more efficient basis. So it becomes very important to understand that even if you don't have much data, this solution will help you in your own data collection journey. It will help you to identify what type of customer data you need to start maintaining from today, what type of behavioral data you need to have maintained from today, so that 5 years, 3 years down the line, you are not in the same phase. You still say that, look, I've done last 3 years and this amount of data I have already automated into my system. So it's important that when we work with you, we start working with the IT team, we start working with the business team, the risk team, the credit team, so that we understand where you currently are in this entire journey. We customize these solutions based on your current state, and based on that, we also highlight what are the best practices. Today you are here, where you want to go 5 years down the line, what type of transformation work you want to achieve by next 3 to 5 years. And based on that, we will customize the solution so that it becomes a business enabler. It helps you to ensure that you are enhancing your business, but without compromising on any of the quality standards as well as risk management standard. So what we have done with multiple clients is we have helped them to create a data mart. We have helped them to do our data quality checks. We have helped them to store data. We have helped them to inventorize all the models in one place. We have helped them to ensure that over a period of time, the data has different types of data included so that a trend analysis can be done. Credit evaluations are all done within the system. Application level information, business level information, everything is saved within the system. You are able to identify exposure to one particular counterparty or a group of counterparty. So all group exposures, related party transactions, everything can be monitored through here. And more importantly, for any of your SME customers where enough financials are not available, there can be shadow parameters. We can help you gather those shadow parameters. And once you have these data points, you can then yourself identify what can be the benchmarks. How do I say that a current asset ratio is good or bad? Because you now have the data, you can do an average and you can then see which customers are good and which customers are not so good. And lastly, as I mentioned, in case there are any non-performing loans, defaults in a bank, what type of learnings you are getting and how that learnings are embedded within the process plays a very important role so that you don't repeat the mistakes. Hence, the solution will ensure there is a lot of standardization, consistency, and a very scientific way of evaluating your customers and enhancing the overall the customer experience for the bank. Yeah. Next slide, please. I think this is done. Daniel, I would like to give it back to you now.
Thank you very much, Amitava, for that candid. You have taken us through and even the system capabilities. And I can see we have one question there from Peter, and says that you noted that modernized lending aims to embed climate risk into credit decisions. What are lenders actually doing in practice today to source the news climate risk data, and what Kenya specific challenges do you foresee as banks implement the Kenya Green Finance taxonomy? Well, this is a very good question, and it's a very timely in my view. And just to bring it into context, is that the central bank issued the Kenya Green Finance Taxonomy and the Climate Risk Disclosure Framework, that is in April this year. And what we are noticing is that this was actually a build-up to the guidance that they had issued in October 2021. And what now this one requires is that it is the first edition to guide banks on classifying green activities and disclosure of climate risks. And what you're looking and what you're finding for example, right in the market, in the adoption path, is that in the market guidance, it indicates, the guidance indicates a voluntary period of 18 months for them to be able to adopt that until now the regulator will now start requiring them to make that formal submission of those particular returns. And of course, it's going to be tiered that the large banks will have to start submitting earlier, and then the mid-tier banks, and then the small tier banks. But what we are seeing in the market, and very specific case, that the early movers there, and some of them are the large banks. And actually, what they have started is that started publishing those particular climate risks and TCFD, the task force, the climate disclosure framework. And what now they are doing is that they are on a path for discovery and evaluating in terms of the gap assessment. And this is where now Amitava talked about alternative data. And this is where progressively they are coming up with data playbook. And what they are doing with this particular data playbook is having minimum data fields per segment, be it in corporate, be it in retail, be in SME. And what they are doing is that they are building up the data to ensure at least at one point in time, they cannot start tagging the assets within the institution as whether they are green or even they are doing a greenwashing. So this is now the data slowly by slowly and progressively gets being put into the system, and the solution we are having right now to be able to price customer loans at the granular level as time goes by. So in short, we are saying that the market is in early implementation. And of course, a few banks have been able to publish climate risk reports and are piloting the portfolio tagging and to ensure that the basic financed emissions, due to how the CBK has given the guidance for every particular sector the bank is lending, they can actually start tagging what green assets are in those particular areas. It's a conversation and it's a very interesting question. Possibly, Mitava, from the experience back from India, we can as well be able to have a webinar again and see what the participants would want to possibly learn more on the climate risk. As you are finding that right now, because of the challenge of data everywhere, it is not as such an easy way. In theory, it's good, but when it comes to implementation, it isn't as easy as we would want to imagine. So if there is any other question from the members, you can please go ahead and ask. And as we are coming to the close of this particular call, we would want to ask what next now. And what next is, what are the simple steps are we going to take to ensure at least we are moving from one step to the other? And we are saying that in terms of the call to action, we want to gravitate from collective assessment of credit risk to individual and more specific risk profile of customers, be it in retail, SME, whether even they are personal loans. And you're saying that through the particular system that and the solution that you're having here, we'll be able to expand data horizons. And what do you mean by this one? You're going to be able even to look for alternative data. And this is how the alternative data comes in to ensure that you're able to profile your customers very well. You're able to ensure that you are profiling the customers in different segments. You're able to price your risks as well. And then automate these particular processes so that you're integrating the judgment and the data because you can understand that human, they have limitations to a particular extent. But when you are having data-driven insights, you end up also learning more, even despite that you experience and have years of experience in these particular credit risk management processes. then you are saying that, then how does the system integrate this one? And Amitabh has been able to indicate this, that credit risk is speaking to other systems, it's speaking to even the other portfolios. How then do you find that even some of the challenges banks face, even in terms of reporting, how then do you able to aggregate exposure that you have been able to give to different people that in related companies? How even do you able to aggregate maybe loans that you have given to a customer, maybe a term loan, an overdraft, the same customer has an off-balance sheet item, the system is able to do all those particular things. But most importantly, is how then do you able to ensure that you're able to have an insight and actually be able to develop those early warning insights. And this is one of the things that you're going to be talking today in the afternoon with regard to how, as a portfolio collectively, how can you be able to have those particular skills and what solutions are there to ensure that at least you're having. But then how can you be able to help? One of it is, and we have been able to work, especially with some of the jurisdictions and in Ethiopia, and we have done a number of support to our clients. We're able to develop even scorecards, both for corporate and even for retail loans. And the aspect of how now even the transition from Basel 1 to Basel 2, the opportunities even for us who already are transitioning to Basel 3 in some of those areas is in terms of how then do we expand data horizons. But data horizons, you cannot be able to do that if you're doing it manually. It has to be through our systems, automate those particular processes, and then embed all other areas. And then who then are the building blocks toward this particular process? So it becomes a very interesting conversation, and we really seek to have your input. And Elizabeth, you can be able to put our poll upward so that even as we brainstorm on even how we can be able to help, then you can have our participants be able to give feedback in terms of how they have been able to synthesize the message that we have been able to give out today in terms of how then do we modernize lending. It is very interesting to find that credit risk, and like I had mentioned when we began this particular session, is that it keeps on changing. Right now, you're having players traditionally who are not bank. They are giving loans. If you look at the market share in terms of, if you look at the M-Pesa platform, if you're looking at those other digital solutions, now you're having central bank licensing, the digital credit providers. Those digital credit providers, they are even telling you that you don't even have to come with a CRB, because they're also having other ways of being able to evaluate you. And more importantly, how do you price this risk? As you can see, the poll is out there. It has a number of questions. You can please just tick and then submit so that also you get necessary feedback to be able to ensure that even as we continue preparing these particular sessions for knowledge exchange, for feedback, and even for more insights from the participant, we can be able to build a strong and a resilient financial system. So please, you continue answering. Just click there just for question, and can tell us how clearly was the functionality of the lending solution demonstrated, which aspect of the hosting solution, and would you like to pursue further, and all those. So without further much ado, I want to check whether Daniel is on call, and to be able to make his remark. But before that, Amitava, any closing remark from your end?
Yeah, no, I think, Daniel, you had been on the target. So it's important that, by way of understanding what peers are doing, what competition is doing, how I can build a more resilient system, how I can standardize and make more consistent risk management practice, how can I increase the overall awareness of my business team in terms of the implications of their business decisions. So it will be very important that to uplift the overall skill set of the bank, we force them into take them through one particular process. And this particular engine essentially helps all the clients typically to go into that particular journey. And then, as I mentioned, the automation is coming completely customized based on each and every bank's requirements. We can make it much more larger, we can make it more comprehensive, we can make it more simpler, just that it'll help you to go into this entire customer engagement journey with your customers. So I just wanted to conclude on that. Thank you, Daniel.
Thank you very much for that remark. And for the participants who are here, please remember to register for our afternoon session on the early warning systems. We'll be able to consolidate all what we have been able to learn this week from fire design automation, ICAP and ILAP automation, RAROC discussion that we had yesterday, today the modern aspect of lending, and then we'll be able now to come and sum up in terms of how then do we manage this in an enterprise level. So looking forward to see you. Thank you very much. And I hope that Peter have been able to answer your question satisfactorily. And you will be able to share these particular slides with you. And we thank you very much. And we wish you a wonderful mid-morning. It's close to afternoon. You go, you rest, and then we meet here at 2:30 p.m. Thank you very much, and have a blessed day ahead. Thank you.
Thank you. Thank you, all of you.